main message I want to just point out to everyone is keep it simple, really find what works for you, and hopefully I hope some of you will take away something from today's presentation. But I guess that gives us a good segue to jump into today's presentation. So today's presentation will be on some basic currency trading strategies as well as some tips. But before we get any further, quick risk disclaimer. So like trading any financial product, trading currencies involves a high level of risk, certainly not suitable for everybody, especially when we're trading with a leveraged product as with trading currencies. Leverage can act as a double-edged sword, and we'll go over some of performances today, some hypothetical performances, but again, of course, past performances are not indicative of future results. So I encourage everyone to do your homework, really know your style of trading before you look to jump into any trades. And again, we want pretty much to be always on the right side of the market. Of course, it can't happen all the time, but we want to take the necessary steps that will help us to be on the right side of the market and help to minimize the risk for losses here. So we'll jump straight into everything. And first off, trading strategy. So these are two basic strategies that I employ on a regular basis, and essentially the first one being trend trading, and the second one being range trading. So trend trading. The assumption that we have when we're looking to trade the trend or follow a trend, it really just assumes that price action will trade in a single direction. And not only that, is when we're looking to trade or follow the trend, we're looking to hold this position until the trend comes to an end. The basic assumption for range trading, on the other hand, is a little bit different from trend trading because 80% of the time, we don't see a trend, but it actually ranges. And basically playing the price action that's confined within what we call the channel or a range. So, some differences between these two. Trend trading, what we're trying to do here is we're looking for a general pattern. Basically what we're looking for is higher highs paired with higher lows, while vice versa, we're looking for lower highs paired with lower lows. And at the same time, some trends can last for weeks, months, and even years. And we'll definitely go over some examples of this. On the other hand, with range trading, it's basically just an area between 2 points. First area being resistance, or sort of the ceiling where price is not able to get above. At the same time, we're also looking at support, which acts as a floor for the exchange rate. And essentially, ranges can last anywhere between days, weeks, and months. So first off, we'll go into technical analysis. And as I mentioned, I'm a big fundamental guy. That was my strength in college, and that's really what I came to love. But again, technical analysis is basically an interpretation of data, and I actually use both of them in my trading every day. So the way I like to look at fundamentals is fundamentals just gives me a general direction of where the market's going. So because we're in Las Vegas, Nevada today, and I'm from New York, for me to get back home, generally I know all I have to do is just head east. And that's how I see fundamentals. It gives us the broader picture, sort of a longer term picture of where things are headed. Technicals, on the other hand, they give us more of a short to medium term bias, giving us a clear signal of, or really what prices we should be watching. So when I take a look at technicals, and essentially when I'm looking at the fundamentals and I have to go east to go back home, technicals are telling me I have to take this highway for this amount of time. I'll have to take my left turns here, my right turns here. So technicals are really the gauge that helps us to know when we should be entering, where we should be entering, where we should be targeting, and where our stop should lie. So basically, technical analysis, again, is an interpretation of price data, and it's really just a study of chart patterns. And my main tool, as simple as it may sound, is drawing trend lines. And I know for those of you that have taken any courses about technical analysis, first thing we learned is drawing trend lines. And during my course in college of technical analysis, it was a 3-month course, we spent about a month drawing trend lines. So, as easy and as simple as it may sound, trend lines are very important, and I use it every day in my analysis. Beyond that, we want to look at some technical indicators that give us some signals. So, one of my favorite ones, and I'm sure for those of you that read some of my reports or some of my analysis, simple moving averages is one of my favorites. Why? We already have that word simple in there, and as I mentioned, I like to keep my trading style very simple. So, applying technical analysis. So again, drawing trend lines. And of course, because the simplicity with drawing trend lines, there are some pitfalls, and we'll definitely go over some of that. But all we're looking for is we're drawing a line that connects at least 3 points. Some of my colleagues might differ. they like to draw the trend lines, getting every little price action into their trend line. But for me, I really like to focus on the closing price. And again, when we're drawing these trend lines, we're looking for some sort of pattern here. Again, when we're looking for an upward trend, we're looking for those higher highs paired with higher lows. Vice versa, when we're looking for this downward trend, what we're looking for are these lower highs paired with lower lows. So, when we're looking to trade the trend or follow the trend, essentially the strategy here is when we're in an upward trend, all we're looking to do is looking for buying opportunities. Vice versa, when we're on a downward trend and we see prices are falling, we're looking for selling opportunities here. So, moving on to our first example here with the euro dollar. This is a daily chart of the euro dollar from all the way back in 2002 to 2008. And basically, what we see here is, again, taking a look at what I've identified here is clearly we see these lower highs. And when we take a trend line of that, clearly we see just by drawing that simple line, we could indicate that ultimately, yes, we should see higher prices. And we see the euro peaking all the way up above 160 level, just heading into 2008. And again, we see it break that trend line coming to 2008, suggesting that this line has been broken, and now we're in a different trend here. But what can we take away from this? Because we have this trend line here, and again, because we're in an upward trend, we're looking for buying opportunities. So where can we possibly try to buy this pair? Ideally, we want to get as close to this trend line as possible. But again, when we take a look at this, the time frame between these years, this is from 2002, and really we don't see that trend line tested from all the way until 2006. So again, those are some of the limitations that we have with drawing trend lines. And I'll tell you, from my experience, I redraw my trend lines almost on a daily basis. If things change, if the market changes, I have to redraw my trend lines. And essentially, when I go into the office every day, the first thing I want to do is, or the first thing I actually do, is I check whether my trend lines remain intact or is it broken, and are there any new patterns forming going forward. And we'll get into some more examples of that here. Here we have our second example, which will be the Euro Swiss, actually the dollar Swiss here. Same time frame from 2002 to 2008, and on this daily chart of the dollar Swiss, quite a different example of what we have. We see the quite opposite here. First, in the euro dollar, we saw that upward trend where we saw those higher lows. But here, we have this downward trend in the dollar Swiss. So the basics behind drawing these trend lines here is, why do we draw this trend line on top of the price action? Is because we don't want to see price break above that. Once we do see price break above this trend line, what that really indicates to us is that this trend line has been broken and we're seeing a shift in the major trend. So these two currencies will be our primary example today. So bringing it back to the euro dollar here. This is a more relative price action of the euro dollar from 2008 to 2011. So again, what do we get with this example here? Now we have these lower highs paired with these lower lows for the euro dollar. And by drawing this trend line here, we clearly see that, yes, we could say that it was in a downward trend during this period, but coming into 2011, it seems as though we might have broken this trend. And again, these lines are very discretionary. And this is just a basic study that I like to implement just to get a general sense of where the market's heading. But it begs us the question, is this downward trend broken? After we saw that rebound in 2010, carrying all the way into 2011. But taking a look at what happened elsewhere, it appears that we are seeing a continuation of this downward trend. Although the slope is slightly different on the trend line, we are seeing a resumption of this trend line here. So quite a different story, in expectations of what we saw happen in the chart earlier. Now, bringing us back to the dollar Swiss example here, 2008 to 2011 on this daily chart. After we saw that break of that downward trend in the dollar Swiss, in 2008 to 2011, we pretty much saw this consolidation pattern where, again, we see a floor here, the support line here, right around parity. While we saw really prices, after this sharp spike here, it really struggled to get back above this line here, just right around that 117, 118 level. So what can we assess from this is, ultimately, yes, this is a pretty broad range, and it's just been holding flat. Not really a trend. We can't really say that a trend, but it's more of a range. But again, remember, from 2002 to 2008, the Swiss franc was in a downward trend. And what do we see here is, after this sort of consolidation pattern, we see this downward trend resume in the dollar Swiss. Quite a different story from the euro dollar, where we saw that upward trend from 2002 to 2008. We saw it break out, and we were currently in a downward trend for the euro dollar. So quite a different story between these two currency pairs. And now, ultimately, we see the dollar Swiss resuming that downward trend. Again, here's our confirmation, where we're seeing it really just test those trend lines, and we're seeing the lower price action, those lower highs that we essentially want to see. So, applying technical analysis to this. So, we just went over something very basic here, drawing trend lines. But moving on to something that's a little bit more and that gives us a better signal is the simple moving averages. And as I told everyone here, this is one of my favorite indicators. I use it across the board. And all simple moving averages do is they smooth out prices over a given period. So my favorites, I use short-term to long-term ones. My shorter-term ones are the 10, the 20, the 50. Longer-term ones are my 100 and 200-day moving averages here. But longer-term moving averages, they actually carry greater weight because, again, we're looking at 200 days or even 100 days worth of data, giving us that better pool of data. But shorter-term moving averages, the reason why I like to look at those is they react more quickly to recent price action, and they also give us a signal on their own. At the same time, we want to look at some crossovers, and we'll get into some examples of that, because crossovers, they tend to give us some directional bias based on some of these movements that we see within these moving averages here. So applying technical analysis again, applying these simple moving average crossovers. All moving average crossovers are is when we see a shorter term moving average cross over a longer term one. And two big crossovers that pretty much we all look at across the board are golden crosses, which will be, I have clear examples of that today, as well as a death cross. And all these are is when we do see a shorter term moving average, again, moving or crossing above or below a longer term moving average. And there's a few ways that I like to use simple moving averages. Again, these are the tools that I like to use in my analysis, which, again, I like to keep everything very simple. So here we have the euro dollar example again from 2008 all the way to 2011. And here we have those trend lines that we have drawn before. But even though if we did not have this trend line and we had no clear direction of where it was going, all we had to do was look at this 200-day moving average. And as I mentioned before, the longer-term moving averages, in my point of view, hold the greatest weight because they incorporate that much more data. So, looking at a pattern for this 200-day moving average, we see a peak here, and then now we see a lower peak in the 200-day moving average. So, what does this suggest to us? If this downward trend is going to continue, that means we should see another low being carved out in the 200-day moving average, making sense that ultimately we are going to see this downward trend resume in the days ahead. But when we take a look at what's happening with the 50-day moving average, here we have, again, because it's shorter time frame, they move relatively quicker. So what do we see here? 50-day moving average peaked. We see a lower peak here. And now, with the 50-day, we are already getting this confirmation that it's already carving that lower top. So we didn't see that with the 200-day SMA because it was a little bit slower. But now, we're seeing a confirmation with the 50-day moving average. So when we compile these together, we get some signals here. So, as I mentioned, we get these two major signals called death cross and the golden cross. So, we typically use the 50 and the 200-day moving averages to gauge these. So, first off, again, we get our first signal all the way back here, just around that September period, where we see the first death cross appear. We see that moving average, we see the 50-day moving average cross below the 200-day, causing this big spike down in the euro dollar. Now, things slowly start to turn around. At the same time, we get a golden cross in the process, leading price action to come back, but again, still holding this downward trend. And now we're continuing to see these lower tops in the moving averages, not only the 50-day, but also in the 200-day moving averages as well. So now, what are we waiting for now is ultimately for this 50-day moving average to cross below this 200-day moving average, which clearly it appears to be coming there. And now we'll just have to wait and see, again, for this moving average crossover to really pan out in the days ahead. So keep a close eye on that, but it seems as though we will get that in the days ahead. Essentially what I like to use both the 50 as well as 200-day moving averages, both. I look for direction as well as a signal that once we do see the 50-day cross below the 200, we might see the similar reactions where we saw in the past, where it's pretty drastic move to the downside once we do see these crossovers appear on the chart. And in essence, it gives us, or it really reinforces the direction that ultimately, although it appears that we have broken this trend line here, maybe this trend line is now coming into play, but relatively, we're still in a downward trend for the euro dollar. And ultimately, based on these moving average crossovers, it seems as though we'll see some more weakness in the euro dollar going forward. Now, bringing us back to our dollar Swiss example, our second example here, we have the 50-day moving average here. So during that consolidation pattern, we really didn't see too much here at all. But once we broke out of support, or once we broke below that floor here that we had just around parity, we saw the 50-day moving average started flattening out, and now it's actually moving along the trend line that I have drawn here. What does this suggest to me? Ultimately, that trend line that I have drawn here, it's actually the right one that I have. And it gives me confirmation that, yes, that line should hold going forward. And again, acting as confirmation, not only giving us the direction, but giving us the confirmation that ultimately the trend lines that we have drawn earlier are initially the right ones. So let's take a look at what's happening with the 200-day moving average. Again, a slower moving average, and again, here we see consolidation pattern. Yes, we did see this lower peak here, but again, giving us this directional bias here, but really just suggesting that ultimately we're seeing a resumption of this downward trend in the dollar Swiss. So in essence, we should see price action continues to trend lower going forward. But moving on now, what do we expect for the support line here? Typically, what we see is when we do see support being broken, ultimately, if we are able to get a good bounce in the dollar Swiss, we could probably see this former support line come in as new resistance, and ultimately, it might become the case, especially if you've been watching the dollar Swiss overlaid, we see the Swiss franc really losing ground heavily. So, what do I expect to see? Might see the dollar Swiss find some resistance right around that parity level in the days ahead. So, something to watch for just as we head into pretty much the latter half of the year, or as the latter half of the year continues to progress. But now, let's take a look with both these tacked on here. So, here we have those signals again. We have the golden cross here, where we see the 50-day moving average. And during this consolidation pattern, we had some good signals here. So we had a buying opportunity here, selling opportunity up here, another buying opportunity, and another selling opportunity here. But ultimately, the last signal that we ultimately get here is that last selling signal. And what we see here is there's this big divergence, or this growing divergence between the 50-day SMA and the 200-day SMA, reinforcing that downward trend and really suggesting that we could possibly see some lower price action going in the days ahead. So, gives us a real good confirmation. And again, simple moving averages, I like to really use them not only as a directional bias, but gives me a confirmation of whether my trend lines are drawn right, and really, are we going to see this momentum continue? So, trend. What are we trying to do here? Again, we're really trying to just identify and follow the major trends. And again, our strategy here is when we're trying to look at upward trend or a downward trend is when we're in an upward trend, again, because we expect prices to go up, we're looking at only buying opportunities. And personally, when I'm in front of my desk, I get a lot of emails saying, David, although we're in an upward trend, why not play it to the downside? My answer to them is, because I don't like to fight the major trend. The trend is your friend, and you always want to follow the trend. You can't go wrong by following the trend. And that's my recommendation to everyone. By following the trend, of course, it all depends on how your trade pans out, on where you get in, but ultimately, by following the trend, it should lead to some successful opportunities and should help to really mitigate the risk for losses. At the same time, these are some different ways I like to really utilize moving averages. Again, moving averages, they act as confirmation for me, but not only that, they give me a sense of maybe things are turning around. Maybe the trend is coming to an end, or are we going to see a continuation of the current trend? Beyond that is we want to trade the underlying momentum. So, as I mentioned before, is every time we see those crossovers, gives us a signal, but we don't want to act until we do see that crossover and until we really see those formations pan out. Just because we see it approaching the move, or because we are making the assumption that we're going to ultimately see this crossover pan out, might not necessarily work out. So again, we want to see that momentum behind a lot of these indicators, and we want to see that pan out going forward. So bringing us to really range trading here. So all range trading is a phase of consolidation more of a corrective move following a larger movement. And we'll definitely go over some examples here. I picked out some good examples so I could share with everyone here. But one thing that corrections really suggest is basically once we do see a phase of correction, it typically tells us that the larger trend typically remains intact and that we will see the longer term move continue once we do see this correctional phase pan out, unless if the major trend is broken. But again, the assumption here that we have with range trading is 80% of the time, price action does not trend, but it actually rather channels. So getting into some examples here and going into some of the technical analysis I like to implement on my charts is support and resistance. Again, the floor and the ceiling. And how do we do this? Simply by drawing lines. And again, what do we do and what is our strategy here? So when we were looking at trends, when we were seeing an upward trend, we were just looking for buying opportunities. Vice versa, when we saw a downward trend, we were looking for selling opportunities. But in here, when it approaches prices, or when it approaches the support, or when it approaches the floor, we're actually trying to look for a reverse in the opposite directions. And or when prices really approach these major significant levels, we expect prices to stall, or really before breaking higher or breaking out of this range. To clear up what I'm saying right now is, we'll take a look at that dollar Swiss example here from 2008 to 2011. So we saw this phase of consolidation, again, in the dollar Swiss. So it's a very broad range, and nothing is very clear. So would I really look to trade this dollar Swiss range here? Probably not. Why? Because, again, we see a clear floor here. Looking back in retrospect, hindsight is definitely 20/20. So we could clearly see that, yes, ultimately that parity level held as support, with resistance coming in right around that 117 level, but not really too clear because looking at the time frame, this was over the course of roughly about 3 years. So what are we looking for is we're looking for clear resistance levels where these are the prices that investors are willing to sell, and we're looking for some support levels where investors are willing to buy. And because that dollar Swiss example, because the range was so broad, here's what I would have liked to range trade here, which is the dollar loonie, or the US dollar, Canadian dollar. Same time frame from 2008 to 2011. And what we see here is, again, coming back to trend lines, drew some lines here. Appears that we do see an upward trending channel from 2008, but we see the sharp move to the upside. And then again, we see this phase of consolidation coming back in. Some good ranges here, but now when we take a look at what's been happening as of late with the dollar loonie, it's been holding this broad range here. And as I mentioned, ranges more of a correction pattern, or more of a consolidation pattern. And again, typically, once we do get this correction pattern, typically we expect to see a continuation of the long-term trend. But in fact, with this dollar loonie example, that's not the case. We actually see it reverse, and now we're in a very different trend here. So going back to going into some of the technical analysis that I like to use, again, simple moving averages. What I look for here is a convergence of the simple moving averages. We'll get into that, as well as Bollinger Bands. And all Bollinger Bands it utilizes the 20-day moving averages, the 20-day moving average. So again, there's my moving average, once again, just in a different indicator. And getting into what I mean by here is tagging on that moving average. So I already tagged on the 50 and the 200-day moving average in this example. So we get that good signal, that death cross here, before we see the trend turn around and we see it really trade within this downward trend here for the dollar loonie, ultimately holding within this clear channel here. But again, the death cross that we had here, but getting deeper into the price action. So this is the dollar loonie from 2008 to 2011. So taking a look at what's happening, we see this broad range here in dollar loonie. And again, we have these moving averages. Again, as I mentioned, just because it crossed over doesn't mean that we're going to see a shift in the trend. Clearly, we see that this was a false signal, but then we see it diverge once again, and now we're seeing it start to flat out. So what does this suggest to me? We saw this downward trend be maintained, and now it appears that maybe we are turning around here. So during this period, we'll have to keep close on what really pans out going forward, but ultimately right now it seems as though we might see the dollar loonie break out of this range. Again, confirmation from this flattening out of the 50-day moving average. Now it appears that the 200-day moving average, which again moves slower than the 50-day, is starting to turn around as well. So moving on to Bollinger Bands. this is probably one of the biggest tools that I use when I'm looking to trade ranges. And again, it incorporates the 20-day moving average here, but all Bollinger Bands is they indicate levels 2 standard deviations above and below, which can act as support and resistance during these price action. And this is one tool that I probably use a lot of times with range-bound price action. And basically, what Bollinger Bands also give us a clue to is when we see the width between those 2 standard deviations start to tighten, it suggests that we'll see a breakout or a big move in either direction. So, getting on with this example for the dollar loonie. Again, we have the Bollinger Bands here, and as I mentioned, we have a tendency to see price action hold within 2 standard deviations above and below price action. So one thing we could clearly see is from these trend lines that we have drawn here, for most of the time, the Bollinger Bands actually hold within the trend lines, reinforcing my outlook that ultimately, yes, my trend lines have been drawn right, and ultimately we should see price action hold within these lines that I've drawn here, acting as support and resistance. Taking a look at that in-depth look of the Dow loonie here from 2008 to 2011, we see that there was only a few amount of times where we saw the Bollinger Bands move out of this channel here, but we saw a test of that here, and then we saw a test of that here. But since then, we really haven't seen too much. And what I also like to do is, while we're drawing trend lines here, I also broke this trend line or this downward trending channel in half. And what do we see here is also a clear signal that now we used to see the price action trade in the bottom half of this range, and now price action is holding at the upper half of this broad channel here. And now what do we see here is another break of the Bollinger Bands, breaking out of this trend line that essentially has held for quite a long time, suggesting that maybe we are getting a breakout. But what are we trying to do here? Basically, again, keeping our analysis simple, we want to draw trend lines and ranges. And although they are discretionary, and because they're discretionary, we're looking for some confirmation. And that's why I actually like to use simple moving averages. And that's the way I like to use simple moving averages. Not only looking for those crossovers, but at the same time, looking for that directional bias and looking for basically some momentum behind the moves. But beyond that, we want to use technical analysis for guidance. Basically, again, we use tools that fit our trading style. So personally for me, I like to hold my trades for a few days to a few weeks. And that's why I like to implement a lot of daily charts. And essentially, that's what we've been going over today. But in essence, what we want from these technical indicators is, are we on the right side of the market? Are we looking at the right thing? And are we looking for a continuation of this pattern, or are we looking for things to turn around here? But again, as I mentioned before, the trend is your friend. Sounds kind of cliche, but that's one model that I follow all the time. And in essence, we don't want to fight the trend until it's broken. And basically, we want to implement the appropriate trading strategies here. So again, when we see a trend break, as I mentioned before, we do typically see a phase of consolidation where we might have an opportunity to trade a range. But again, 80% of the time, we do expect prices to hold within that. So if we do see a breakout of that range, in essence, most of the time we should see a continuation of the pattern like we did see with the dollar Swiss. But like what we saw with the euro dollar, things might turn around here. But that's pretty much all I have for everyone today. I just want to thank everyone for joining me today, and hope to see you all tomorrow.